going forward, at least from a market standpoint, what according to you could be that one defining moment for 2026?
Good morning, Nanita. Like you said, 2025 was quite an eventful year. It made us see a lot of stuff. In 2026, I personally think from a capital market standpoint, every year will have some triggers and some events which will happen. That's how year progresses. But if you ask me what will change the trajectory of this equity markets in 2026, I would say FIIs returning, and that should happen is my second guess, and I would say that could create a rally which has been waiting to happen. Why do I say so? Is because 2025 has been the highest ever FI outflow. If you see FI 20, the calendar year 22, FI sold about 1.25 lakh, 1.25 lakh crores, and last year, the year which is going by, they've sold 1.5 lakh crores. The subsequent year, which was calendar year 23, FIs bought 1.7 lakh crores of equity. So point I'm trying to get is when there are steep sell-offs by FIs, the subsequent year there is purchase because the active FIs sell and go. And in the same year, it goes unnoticed, DIIs bought 7.5 lakh crores. As a percentage, now FI outflow being the highest ever is still 15% of the inflow of the domestics in that specific year. This has never happened. In 2000, FIs bought 3,000 crores. In 2003, they bought 30,000 crores. In 2008 crisis, you know how much FIs sold? 52,000 crores. They've sold 3 times that in this year. And still markets have maximum drawn down 8.7%. So I'd say FI coming back would be the defining moment, and that will trigger the equity markets upwards.
So if somebody is building a mutual fund portfolio today, for 2026, where should they focus for better risk-adjusted returns? Any suggestions here?
Yes, but if somebody is building a portfolio of mutual fund now, and if he's above 30, then I first tell him that he's too late. Stop procrastinating and actually get into it. So that's one suggestion, because quite a few people do a lot of study before they want to even dip their feet in water, and that really destroys a lot of value. Now, having given the philosophical yarn, let me come to what can one do. From a risk-adjusted standpoint, can buy multi-cap funds, because multi-cap has the flavor of all three. In our humble opinion, all the three, which is small cap, large cap, and mid cap, are all at a stage of almost an equilibrium in terms of what potential they have in store. Little skewed towards mid cap. Because mid caps have this huge benefit that all different funds buy mid cap, and mid cap there are just 150 stocks. Large cap has some degree of mid cap, multi cap has mid cap, flexi cap has mid cap of course has mid cap, small cap also has mid cap, but they're just goddamn 150 stocks with $1 trillion free float. So I personally think $1 trillion market cap, not even free float. So there's a lot of buoyancy in terms of P's and contractions not happening. So coming back, I'd say buying a multi-cap would be a good risk reward. And I personally think people should stop getting scared of Indian small caps, because Indian small cap is not the true small cap. It's in the top 500 companies, mutual funds finish all the stocks. 100 large cap, 150 mid cap, and 250 small cap. The rest of the 2,000 traded stocks are all considered not even in the small cap category. MSCI has 500 small cap stocks. So don't be too intimidated with the word. English word is still called small cap. About 8-10 years back, the largest small cap was 8,000 crores. Today it's about 40-50,000 crores market cap.
How does one really look at this entire rally? What kind of an asset allocation strategy should one adopt, at least when it comes to some of these precious metals?
To be honest, coming one small point on the small cap index, like it is ending this calendar year at negative. If you look at the previous year, it makes up for it. Small caps or any equity instrument or a segment of the instrument cannot give you linear returns, right? And that's why you deserve 14-15% return and not 7% return to to accept the non-linearity of the instrument, and small caps are a little more non-linear than large caps. Coming back to the metal rally, like you said, it shocked me for sure. Right, the last time we spoke, silver was at $50 troy ounce, if I'm not wrong. So now we are at 77 today, right? 77, 78. That's a large move in a span of a month and a half. But it is to my mind, it's I have been shocked. And there's one listed company which has silver as a byproduct of their mining. They hedge their positions at $36, if I'm not wrong. So if the guys who do it for a living couldn't guess this rally, then who am I? So point I'm trying to make is silver has this unique attribute of giving 10-year return in 1 year and then relaxing for the 9 years. This is what an investor needs to understand, and then invest or not invest is a separate story. It gave 13 years of negative return in this century. 13 years. But you have the patience to buy at 77 and maybe see 100, sell it off. So it's a trading instrument, not an investing instrument. An investing instrument which has such non-linearity. That small cap, we are perturbed by about a 6% negative move for a year. But silver from 2011 to 2024 gave a negative return in rupee terms as well, in spite of the rupee depreciation over the period.